My CPA said, Dan, never invest for depreciation. Depreciation is icing on the cake. The deal has to work first. Fundamentally, does the deal work? Hey everybody, I'm Dan Brisse. Welcome to another episode of Keeping It Real Estate. Today, you guys, I want to talk about the thing called the institutional floor. And that is why is Wall Street hoarding cash? So you got this $300 billion dry powder reserve, and it is the institutional funds like BlackRock, KKR, and they're currently sitting on these record levels of undeployed capital, specifically earmarked for commercial real estate. Right? They raised the capital knowing what's coming, and they're waiting for the right opportunity to buy at the bottom. They didn't raise this money to sit in treasuries, right? They raised it to deploy aggressively when the market bottomed out. And their internal data shows that 2026 is the bottom. That's what their data is saying right now, you guys. And so their whole model is buy the blood. If you go back to the Rothschild family, one of their famous quotes is to be a buyer when there's blood in the streets, even if the blood is your own. And so these mega funds, they're waiting for the exact same distress we at Granite Towers are targeting, right? We're targeting operators who bought in 2021. They failed to secure long-term debt. They over-leveraged it. They put their CapEx in the debt, and now they're forced to sell. And Wall Street knows the underlying fundamentals of multifamily are incredibly strong. These deals are not deals that are not fundamentally put together. When I say fundamentally, occupancy is strong, rent collections are strong, job growth is strong, delinquency is low, expenses are in line. That's a fundamentally well-run real estate deal. The problem is that they're over-leveraged. The debt payment is too expensive, right? Variable rate debt, if you bought in 2021, your rate changed dramatically, and you've had to feed that new interest rate. And when you do that, the bank takes over into a lockbox. I've talked about this in the past. These banks will step in and put you in a lockbox. Bottom line is they'll take the rent, they'll take the income, they'll pay themselves first with the interest, and then give you a little bit extra left over to pay your expenses. And there's never enough to pay for your deferred maintenance when you're in a bridge loan with an increased variable rate loan. So these deals have deferred maintenance. We call them a death spiral, right? They're hollowing out almost. Imagine it like you've got decaying property that can't be maintained because all of the capital is going to the bank to service the debt. It's really simple. And as that happens, residents obviously aren't interested in sticking around, right? They're like, we should get out of here. The property isn't being maintained well. It's not being managed well. I even called and asked maintenance to come by and take care of X, Y, and Z. They didn't show up. That's how you have apartments really go down the tubes quickly. You got to come in with enough capital. You got to keep your debt under control, and you got to take care of the residents. Service to many leads to greatness. Right? Service to many of these residents is what's going to keep them in their seats. Heads on beds is what we like to call it. And so Wall Street is waiting to scoop up premium assets at a 20 to 30% discount, potentially even more. So for those that know what they're doing, right now is the most exciting time we've seen in the multifamily space since 2012, 13, and 14. Undeniably, right now you have the most opportunity that we have seen in the multifamily space in over a decade. And the reason that you can almost say with certainty, now you never can say with certainty because the cycle could get more exciting if we go lower. But the reality is you can make these deals work with 65 to 70% fixed debt, and you can raise all of the CapEx, and you have an elevated interest rate, and you're still able to buy. See, if you wanted to buy in 2021, you had to use variable rate debt with a very, very, very low interest rate, leverage to 80, 85, or 90%. And by the way, debt is like a double-edged sword, you guys. Okay. The more leverage you use at a lower rate, the more you can pay, right? Because you're not having to raise as much capital. You're borrowing it very, very cheap. So you're able to push the price of assets up. It's again, double-edged sword. You over leverage. Oh, rates ran. Now you lose it all because you over leverage the deal. And so if you keep your criteria in a place where we only buy with fixed debt, let's just say that was one of your pieces of criteria back in 2021 or 2020, you wouldn't have been able to buy And it would have been the best thing ever. Keep that in mind right there. Because what happened is FOMO got into the market, fear of missing out. Everybody else is doing it. Everyone's going in. We got to go in too. Let's keep going. You're having, and honestly, like from 2012 to 2021, you kept making money and kept making a lot of money. And so you might have a deal turn, later in the cycle, like from 2020 to 2021, and you might double people's money. And so these investors, let's just say, put in 100 grand, right? And you exit only 12 months later and you give them 200,000 back. Their thought is these guys are geniuses. Man, I need to keep giving my more money to these guys. When in actuality, the cycle was peaking. Cap rates were compressing. Rents were going ballistic. FOMO had set into the market. And you had folks exiting these deals, creating these insane gains, which caused them to have a capital gains problem. And they were extremely desperate for depreciation. My CPA said, Dan, never invest for depreciation. Depreciation is icing on the cake. The deal has to work first. Fundamentally, does the deal work? And so it became very difficult for operators and investors to say no because they just had a decade of winning and everyone had more cash that they needed to find a home for. And the music stopped the day the Fed really started to jack rates up. And so that's the end of a cycle, right? Market peaked, blew off, Federal Reserve raises rates, and pricing starts to come down after a bunch of deals were locked in with this variable rate, were put together with variable rate debt, but it was not locked in debt, right? It was variable. And so that was the beginning of the bloodbath. And so since 2022, it's been this step down, 23, 24, 25. And we're starting to see the bottom really set in. We're starting to see people that are coming to the market that are forced to sell, right? They put in these loans in 2021 with 3 years plus one. That's how variable rate debt is set up. And I know because we've had it. And so you get this 3 plus one. And at the end of that, the lender says, hey, I've given you guys enough time. It's time to go to the market. And at that time, either you refinance by raising more capital from your investors to pay off your initial note and you deleverage the deal, stabilize it, or you go to market. And when you go to market, you're taking pricing based off of the new valuation. And the new valuation takes in softer rent because there was a huge glut of supply that came through in 2023, 2024, and into 2025. And that glut of supply pushed rents down and vacancies up. Rates are still up because we as buyers now have to use what rates are today. And you might, if you're lucky, lock in at 5.1. That's on Fannie Mae and Freddie Mac as of today, 5 to 5.1. If you're going with banknotes, 6.3, 6.5, 6.8, somewhere in there, very high. And so you cannot pay as much as you could pay back then. So valuations are down. And so you've got this retail investor disadvantage. And I'd call that where the high earning doctor or the tech executive, they cannot compete with a $50 billion private equity fund, right? To buy a distressed 300 unit apartment building. So if retail investors wait for the media to announce that real estate is safe again, the institutions will have already bought it up. They're going to be out buying these discounted inventory prices and the prices will have a reset higher. And so most retail investors, from what we've seen firsthand, they got really excited about the end of the cycle. The last 3 to 4 years, those retail investors were piling in. And unfortunately, they got trapped in these deals. And I know because unfortunately, we have some of them. Some of these deals that were purchased later in the cycle, we really wish we wouldn't have bought them. Would give anything to go back and stuck to our underwriting and passed on several of these deals. And so that capital is locked up. The best chance you have of getting it back is hunkering down, waiting for the market to recover and selling towards 2028, 2029, or even 2030, which unfortunately, if you closed in 21 or 22, that's likely your exit window, your first opportunity to exit. That's if you got out of the variable rate debt. That's if you refinance. That's if you've locked in your debt. That's if you asset manage well. That's if you have great property management. There's a lot of ifs, a lot of headwind. And that's why we're seeing such an opportunity to be buying in this market because you've got a lot of distressed sellers. And whenever you have distress or blood in the streets, it's generally the smartest time where the new capital comes in now and takes these assets that are great assets, fundamentally doing great, right? Rent is strong, occupancy is strong, delinquency is low, expenses are under control. but the debt is just too high. They can't survive. They have to go to the market. They have to sell. And then you look at the smart money opportunity, right? You don't have to beat the institutions. You invest exactly like them, but faster. And the strategy that we're employing right now at Granite Towers is we operate with the same ruthless underwriting as the mega funds, but we open the doors to accredited retail investors before the big hedge fund folks come in. And by pooling capital now, we can acquire these institutional grade assets at the absolute bottom of the cycle. And we're riding this massive wave of institutional cash that will eventually drive valuations back up. That's where you want to be. You want to position yourself to own assets in strategic locations with the right level of debt fixed with a nice value add strategy so that when these institutional capital buyers come back into the market, they now start to bid up the prices of these assets that you strategically got into your portfolio before they did. And now you enjoy the wave of appreciation and enjoy the wave of creating value for your investors. If you want to learn more about what we do, reach out to us at granitetowersequitygroup.com/contact us. Would love to get on a call with you, and we'll talk to you soon.